This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Ready for a good butt kicking right now, I think.
Yeah, you knew this one. You knew this was coming. I gave you an opportunity last week. You can go check out Taylor's playlist. I gave him two opportunities to
yes, you did. You tried to convince me twice
to walk back his prediction on a soft CPI of 8.6. It did not come in. It came in at 9.1. But I will say this. The reaction of the bond market does not make sense to me. And frankly, as far as the market reaction, it's kind of probably what you wanted to happen. It was kind of a muted response, but I would not have guessed 9.1 and bonds got better. Would not have been my guess. Wild. What happened?
Yeah, it's interesting. And the difference is when you look at the bond market, we'll talk about treasuries because they're the one that reacts the most severely off of this news and what everyone points at. So everyone looks at the 2-year Treasury and the 10-year Treasury. And we talk a lot about this. The 2-year Treasury is referred to as the front end of the curve. You'll hear it called a lot. The front end of the curve is almost directly responsive to what the Fed does.
Yeah.
So when the Fed raises rates, the front end bumps up along with it. And that's what happened. So last week you had the front end of the curve move up, but on the other hand, you look at the 10-year and out further than that, being the long end of the curve, being more reactive to things like the projections for growth, recession, non-recession of the economy. And essentially what you had was the 2-year reacted, it moved up with rates moving up. And the 10-year said, yep, that's going to put us in a recession. And that's exactly how the bond market reacted.
Yeah, I'm trying to pull it up right now just to make sure this is still technically correct. Yep, it is still inverted. So
yeah, it's inverted by like something like 18 basis points too. That's not like a modest inversion. It's been consistently inverted since last week too. So a lot of times you'll see a slight inversion and then it'll revert back. We have not seen that.
Yeah, so we went, as I recall, we went slightly inversion the day before the release, but then it got worse and progressively worse. I think we peaked at like 0.22. I think it was Thursday, might have been Friday morning. But yeah, this inversion, and it's sticking, right? We're now day 5 of inversion. That's why I wanted to check. It's really weird. The smart money is basically saying, this is what I think the smart money is saying. Please tell me if I'm wrong. You're a 10-year Wall Street guy. I am not. Basically, they're saying on the front end, the Fed's got work to do. And on the back end, they're saying the only outcome's a recession. And that's kind of what it's saying, right?
Nail on the head. There's no two ways about that. That's what the market is saying at this point. The market's saying, again, the Fed needs to continue to raise to beat down inflation, which is still markedly hot, as we talked about there. And the other end of it means that the market's saying, hey, as they continue to raise rates higher and take debt financing higher on all these major corporations, allowing them not to build out the factories, allowing them not to hire that additional employee, et cetera, that is going to force us into recession. By the way, you continue to see a build out in the use of credit cards by the consumer. And so that's just saying, again, as credit card debt goes up and as the Fed takes rates higher, that debt financing just gets more and more and more expensive. It's all a negative feedback loop caused by the Fed. The most simplistic way, and this is, again, an oversimplification because the Fed generally is not moving up or down with rates. That only happens on the extremes. When the market's too hot, like they just said it was, or it's really bad, they're cutting rates on the other time. The in-between stage is the normal stage. But when the Fed is raising rates or cutting rates, the famous Wall Street line, don't overcomplicate it, is don't fight the Fed. Simple. End point. Don't fight the Fed. And the Fed continues to say, we're going to take this thing higher because we have to. Inflation's too hot.
Yeah, I mean, I'm looking at the whole curve 3 month out to the 30-year. The 1 year is above the 10. The 2 year is above the 30. So here's a question for you. Do you think the 3 month gets above the 10-year anytime in the next 60 days?
It very well could happen. Yeah, it would not shock me.
Wow, the 3 month, 10
well,
year.
I'm sorry. I thought we were talking 2 and 30. So 2 and 30. You're talking 3 month and
3 month
so
and 10.
Yeah, the 3 month is at what, like 2.2, something like that.
2.38. 2.38.
2.38. Okay, so that would have to move 60 basis points or somewhere in that ballpark.
Roughly, yeah.
Yeah, so that's probably not likely. What you have there is just.
But hold on, but it does. Do you think it gets closer? Because right now it's basically 62.
It will get closer.
Yeah.
I think it definitely gets closer, because what you have is, again, the front of the curve prices in the Fed rate movements. If the Fed continues to say we need to be on the gas because we need to beat back inflation, that's going to continue to go higher. And I think that's a real reality that's likely to come here. Well,
Yeah.
you've had an incredibly flat curve for most of the year. You've had the 5s and 7s over the 10s for a period of time. That's
now the one's above the 10.
Right. And the reason you look at the
Wow.
2 to 10, the reason you look at those two is because they are the most heavily traded and the most liquid. So they are the most actually reactive to what's going on in the market. And so that's why you see when that 2 to 10 inversion, all of a sudden sirens start going off, flashing red lights, etc. And that's what we saw.
Dude, the 2 and 30 is inverted.
Yeah. And again, the back end, to simplify this is again a very simplistic look at things. The back end of the curve is based on essentially two things that go hand in hand together: inflation expectations and growth.
Yeah.
So what the back end of the curve is saying is two things: growth is coming in, and it's going to cause inflation to come in. Now that's like, people are looking at me like cross-eyed right now. They're like, inflation coming in, it's at 9.1. We get it. That said, moving forward, the market's saying that inflation is going to come down, and the commodity market right now is rolling over on its face, saying that that's the correct thought process. The front end of the curve, again, is the Fed. The Fed dictates the front end of the curve, and the market's projections of where the Fed will have to go.
So now that we're sitting here, since we do have a Fed call next week, we'll probably talk about this again because it'll be 2 days ahead of time. Do you think they do 75 or 100 or 50?
So I don't think they should be doing. I think they need to be coming down. I mean, it's crazy to say that inflation, I believe obviously inflation has peaked. It's crazy to say this. I think the Fed is being too aggressive. I think the Fed is tightening us into an almost definitive recession. And now the market is rallying today, so we can talk about that too. But that's, we'll get to that, I think, in time. I don't necessarily see the reason behind that. But at the end of the day, I think the recession is becoming more and more inevitable. The data is alluding to the fact that we're moving in that direction, it seems.
Yeah. So again, I'm gonna try to back you into a guess, because right now you tried to walk around it. So we'll try that again.
Oh, I love this. So by the way, let me say something quick too. I focus on rate of change, and you focus on the hard numbers, and you pin me on hard numbers, and I'm like, no, inflation's coming down. And you're like, yeah, but what's the number?
Dude, I used to be in sales, and my sales guys always talk around the number. I'm like, I got to write something on this spreadsheet. So what number am I putting down exactly? Because you haven't answered.
Go ahead, get me on. I'll get you the answer.
So July 27th, the Fed will be releasing their decision.
Yep.
It will either be 0, a quarter, a half, 3/4, or 1. What's your dealer's choice? Not what you think they should do, what they will do, because those obviously can be different.
Yep. Yeah. I think they do 75.
Yeah.
If you had spoken about this a week ago or a couple of days ago, I guess that was last week, right? 100 looked likely.
Yeah, I think that was
likely.
Yeah, that was basically the market getting ahead of itself.
We talk about this a lot, and what you see is that the futures market changes massively when it's all over the place.
Yeah.
And so, but longer term, it's still volatile, but longer term it normalizes. And you're still seeing cuts coming next year.
Yeah, we are. So the real question, the real fun, because I think 75 is like a 99% chance.
Yeah,
right?
you're probably right. Yep.
It's communicated. The data is kind of leaning that way. They're still below neutral. I mean, this just like everything, right? But September will be interesting because they actually have 2 months of economic report. And by then you could have a trend. CPI could have peaked at this print. You could have it go down a couple of tenths, maybe fall a couple of more. You could have this commodities rollover. I have a guy that comes on Sundays. He showed all the commodities just face planting in the last 2 weeks, from lumber to soybean to just oil,
copper, wheat, corn, all of them down double digits in the last month.
Yeah, so that will eventually ripple through. I don't think it really impacts this month, but certainly the next month, because futures versus what I buy on the shelf, very different. But September. I think September is going to be interesting. I think more people will be. If I had to guess what you're going to say about September, you're going to say pause. If I had to guess.
Well, with it being so hot, I don't think it is paused, but I think
Okay.
it's come off of 75, come off of 50, go to 25. Like I
Okay.
think that something very low needs to be. Again, I just think that the Fed is going to realize very quickly here that we are going into a recession. How long have I been talking about commodities with you and the rollover in commodity prices? Too
Oh,
long, because
yeah.
I've been saying that inflation is going to come down because of that, and you're like, dude, it doesn't work that way, and you're right, because it takes time to melt through the system. But
Exactly.
when you
Price
look forward
elasticity.
and say,
Yes.
where is the market going to go? Commodities are a really good leading indicator, and they've been well ahead of all of this. You see every
Yeah.
palladium, which is a big component of chip makers, coming in. Copper is the one that I look at most frequently.
Dr.
Copper's
Copper.
down-
Yeah.
Dr. Copper's down 27%
Yeah.
in the last month, which is, I'm sorry, I misspoke there. 22% in the last month.
Yeah.
And the big one is oil, right? So that's the big one that everyone pays attention to. Oil's down 14% in the last month.
Yeah.
So that's the last one. And that has all the exogenous events that drive it as well. So that's a little different, but nonetheless, everything seems to be trending that way.
Yeah. So this is the big question I have, and maybe we'll work this into another video, but basically the 9-1 print, let's just assume it's the high water mark. The next question you have to ask yourself is, what part of that is kind of supply chain, commodity versus what part of inflation is sticky? Because I think you've heard from Goldman Sachs CEO Solomon, I think, David, he's basically like inflation is far more entrenched than people realize. So some part of that 9-1 is froth.
Yep.
But there's probably a disproportionate part of that that's real and sticky.
And the supply chain's not perfect yet either. Like the supply chain will abate, but it's not perfect by any stretch.
No. Yeah. So again, folks, CPI hot. I had to make fun of Taylor a little bit because I gave the guy
all good. Hey, rightfully so.
Yeah.
Rightfully so.
Yeah. Oh, this is a lot of fun, man. Well, do me a favor. Where can people follow you?
Yeah, follow us at Life Goal Investments on Instagram, at Life Goal Investments. Appreciate
Awesome.
it.
Thank you, buddy.